Hello, everyone, and thank you for joining us today. My name is Andrew Dixon. I'm the publisher of Crowdfund Insider, where we cover all things fintech, including securities crowdfunding. And today we have a very interesting topic to discuss. It's about the crowdfunding market in 2023. First of all, I'd like to wish everybody a happy holidays, a Merry Christmas, and a happy Hanukkah, and thank everybody for being here. And I would like to ask our panel of experts to go around the room here and do a brief introduction. And I'm going to start with you, Eitan. And if we can just go around the room clockwise, please.
Thank you, Andrew. Great to be here. Eitan Butler here. I'm the founder and chairman of Dalmore Group, a fintech broker-dealer specializing in helping companies raise capital online at scale. And been on this with many of the folks on this panel a number of times before. It's great to see all of you and look forward to a productive conversation.
Awesome. Thank you, Eitan. Sarah.
Hi, Sarah Hanks, CEO of CrowdCheck Inc., managing partner of CrowdCheck Law. And between the two of them, we provide a wide range of legal compliance, disclosure, and filing services for all of the online exemptions, Reg D, Reg A, Reg CF.
Thanks, Sarah. Rebecca.
Hey, thanks, Andrew. Glad to be here. Hello, everyone. I'm Rebecca Casaba, CEO and co-founder of Dealmaker, a fintech with the goal of making online capital raising mainstream. So your digital back office for any kind of capital raising geographically, wherever you might be placed.
Thank you, Rebecca. Woody.
And I am Woody Neese, a principal with Crowdfund Capital Advisors. We sort of sit at the intersection of three themes that we see going on in the industry. One, which is data, and we collect information on all the companies that are raising money online. Another is venture. We have built a venture fund that with the goal of using AI and machine learning to invest in crowdfunding offerings and hopefully get institutional capital in the space. And third is liquidity through our sister company called Guard, where we help companies with secondary trading and these securities that are exempt and unregistered and unrestricted so that they can trade on alternative trading systems.
Awesome. Thank you very much, Woody. Okay. Now I'm getting a little echo. You hearing an echo here? Lucky me. All right, we'll see if it persists. All right, so first of all, I want to give a shout out to both Woody and Sarah because we have two, true OGs of the securities crowdfunding industry. There's a lot of people out there who claim to be the godfather of, whatever, but both Sarah and Woody were here, working the halls of Congress and pounding pavement on F Street before the Jobs Act was signed into law in 2012. So, thank you for all your efforts, and I appreciate everything that you're doing today, which is awesome. Now, in regards to online capital formation, first I'd like to talk about global venture capital, because that market has really tanked this year. So we've published multiple articles indicating, how it's declined. They're kind of depressing. S&P Global Market Intelligence said that it's hit a 4-year low. At the same time, we have online capital formation. So I think it's interesting to contrast the two. So that's part of what we're going to discuss today. And when I talk about online capital formation, specifically, I'm talking about Reg CF, regulation crowdfunding, where you can raise up to $5 million from both accredited and non-accredited investors. Reg A plus or Regulation A, where you can raise up to $75 million in a mini IPO type offering where you have to file certain documents, but that's a pretty interesting exemption. And then, of course, there's Reg D, and Reg D is always in the mix because it's the largest exemption, the caveat being that only accredited investors can participate. So to kick things off, I'm going to ask Woody to share his data to date for the Reg CF market because he's really the data guy when it comes to this industry. And so he tracks all this. We write about this and we reference CCA all the time. So Woody, why don't you take things over here and share what you've seen in the market this year?
Okay, well, let me start by saying there was a paradox going on. I think that is the backdrop to 2023. If you look at the macroeconomic and geopolitical events that were taking place, when you go back to the beginning of 2023, we had these supply chain issues, we had hyperinflation, we had the Fed come in and they raised interest rates. And so that means that there's alternative opportunities for investments to be deploying their capital outside of, online investing. Then you have these geopolitical events that were impacting the public markets. And so it's sort of this roller coaster ride, but we sort of saw how now we've got, the economists saying that, a recession's off the table, or we're in this soft landing. They pulled back all of these fears that we have for 2024. And so we're ending the year, I think, on this sort of exuberance. So when you look at what's happening in the marketplace, I think that plays out in the 3 slides that I'm going to present. This first slide really just talks about the capital commitments that have taken place. And so we're going to see 2023 end up over 2022 with a larger amount of capital that's being committed by investors, but less than we saw in 2021. Now, if we do hit this sort of pulled out of the recession fears and we hit the soft landing, we think that we're going to actually hit a high in 2024. But investors were putting more capital into the marketplace in 2023 than they were in 2022. But it was a different thing than when you look at the next slide, which is the issuers that are coming into the marketplace. This talks about the deals, and the 1358 is actually where we are as of today. I think we'll probably end up closer to about 1458 new deals for the year. So when you look at, there's more capital, but there's less investors or deals coming into the marketplace. Well, what does that mean? I think that sort of plays into what was happening in the market dynamics with issuers thinking, is this really the right time for me to go to market to raise money? If we've got all these, hyperinflations and the fears of a recession, maybe now is not the time I should be raising capital. In addition to that, think about the cost to running these businesses. That increased as well. So people were probably thinking, I need to be conserving my cash. I need to be, working with what I have on hand as opposed to going out and raising money. And I think that played into the pullback that we saw in the marketplace in 2023. I think, again, this is all going to change in 2024, and we're going to see more issuers come into the marketplace. I think a lot of this is because we've got more platforms in the marketplace that are facilitating these offerings. We do a lot of communication with companies that are raising money, and you often hear them talk about community. That's the big thing about crowdfunding is community, because you're engaging your customers as investors, but they become advocates for these companies that are raising capital. And so I think that messaging that happens with these, investors that are out there talking to other people increases awareness for the industry, will help bring more issuers into the marketplace and bring more investors into the marketplace as well. But if we go to the next slide there, you'll see that this is checks written. And again, I think this plays into the fear that was going on in the marketplace where investors might have been thinking, I don't know if this is the right time for me to be deploying capital into the marketplace. So we saw a pullback in the number of investor checks in 2023. I think it'll be flat. I think it'll be about the same as 2022 when we end the year by the end of the month. But it's not nearly going to be as much as we saw in 2021. But what's interesting when you take these slides and you put it all together is, a pullback from issuers out of, confidence really in the marketplace that I think will change. And investors were shaky, so there were fewer investors that were in there. But the investors that were in the marketplace were deploying more capital than they have in the past. So they were writing larger checks. And that bodes well, I think, for the industry to know that the people that were in the market are in the market for the long term. And I think they're willing to make these bets in these startups and small businesses, particularly if they have diversified portfolios that allow them to allocate a percent of their investments into these high risk alternative assets. And so I think 2024 is going to be, it might not have the same number of investors. I think in this chart right here, you can see the number of checks written might be even, fewer than we saw in 2023. But I think the amount of capital will increase because I think the sentiment from the public markets will trickle down into the private capital markets here, and we will see that amount there. And I do think we will have that rebound that we're expecting in issuers coming in 2024.
Awesome. Thank you very much, Woody. Yeah, my one recent data point from S&P Global Market Intelligence said that venture capital declined 27% year over year, and that was as of October, and that was the lowest total since 2020. So yeah, you do have some sentiment spillover there. The economy has been really rough this past year, but I would call the Reg CF market resilient, and I'm stealing that. I'm stealing that from you, Woody. I'm getting a little bit of echo here. Sorry about that. So I remain optimistic, and I agree with you. I think that 2024 is going to be a different market. Now, I want to quickly share some Reg A and Reg D data. There's not a lot of Reg A data out there. I was digging around, going on the SEC website. They actually have some raw information that's very poorly presented. But earlier this year in February, they did a report where they quantified Reg A and Reg D through June of 2022. So it's a little bit old, but under Reg A plus at that time, issuers had raised 1.8 billion during that year, that cycle. So that's not a small amount. It's not enormous, but it's not small, with a median of $2.2 million. Reg D 506B, and that's the private placement where you can't promote it online, the old Reg D, that raised $2.3 trillion or a $1.3 million median. And then Reg D 506C, which was the update to Reg D under the Jobs Act, $148 billion with an 800,000 median. And that's the exemption that you can promote online, which is what most funding portals and broker dealers are leveraging today. When you compare that to the IPO market during the same period, the IPO's markets was $126 billion. So Reg D is enormous. It always has been, probably will continue to be. But what you're seeing is a rising tide with the other exemptions moving forward. So from my point of view, and I'd be interested to hear your thoughts on this, Woody, quickly, is that we're in a pause period, but still we're seeing good activity and we're queued up for a stronger 2024.
I agree 100%. I think, everyone had to take into account what was happening on, like I said, the macroeconomic and geopolitical stage to see what they wanted to do. But I think, industries start and they evolve. Okay. So if you just look at what's happening in this industry, by default, it's going to evolve no matter what. I mean, unless there's some fraud, and I'm sure there's some people on the panel that would love to talk about it, that takes down the industry. But I think it would be very difficult for one fraud to destroy it. But I think it would give it a bad, a bad mark on the industry. I think we're just going to move into this upward trajectory. When the bill passed in Washington, D.C., just as an anecdotal thing, I remember talking with Karen Kerrigan about what this means. And she goes, Woody, for the next 5 years, this isn't going to mean much. This is going to be like health savings accounts. They passed and nobody knew about it. And so it took 5 years before people really understood what health savings accounts were. And now everybody has them. So you have to take into account that there's going to be this slow period at which we, build awareness and traction. And, of course, health savings accounts are very different from securities, issuing securities and regulations that come with it. But I think the whole story plays into that in the sense that we will be moving upwards in terms of momentum, and there will be more. I think when we have the exits that will be coming, I mean, there's $66 billion of pent-up valuation or, enterprise value that's been built in the companies that have had successful offerings to date. As soon as liquidity comes from those companies and these retail investors that invested in this become millionaires, and, the Today Show and, Fox Business starts covering that, this will become a media sensation that drives more awareness to the industry, drives more issuers into the marketplace, and drives more investors in. So, I think that is what the next few years will be. And, I'm sure we're going to see some fraud in the marketplace and some stories about that as well. But, I think this is what happens in both the, the private capital markets and the public capital markets. But I'm very, bearish on it.
Okay, so I haven't forgotten about Eitan or Rebecca, but I want to jump over to Sarah first because Sarah and I connected the other day and we had a discussion, and she immediately focused on industry challenges. And these are things that you have to tackle head on. And First of all, I'd like to say that this is a very young industry. It continues to evolve and grow, and people are figuring this out. We're fortunate to have two platforms here, which are newer entries that are hitting online capital formation from a little bit different angle, and they're doing some really cool things, which we're going to hear about in a minute. But Sarah, the first thing we talked about the other day on the phone was Reg CF and people not filing the documents they should be filing. Do you want to talk about that a little bit?
Yeah, but first I'm going to say I should have been putting a little disclaimer under Woody as he was talking, saying not everybody will turn out to be a millionaire. Stocks go up as well as down, or down as well as up, don't it? So yay to those who might become millionaires. But that's actually one thing that is actually we are seeing in terms of the challenges of an industry that is still in its infancy, its absolute infancy, is we are now seeing the very early days of the acquisitions and the exits. And one of the things that I want to say with respect to the challenges of both CF and A is there are rules about how acquisitions work. And to the extent there is ever an investment decision, which includes votes, so votes to accept an acquisition offer, that's what we call a Section 5 event, something that needs to be registered or exempt with the SEC's rules. And that means what we're seeing at the moment, and I've got like about 3 of these on my screen at the moment, is here's an exit, here's an acquisition. And in some circumstances, because of the way the security or the terms of the security were set up at the beginning of the offering, the little investors are not being made millionaires. It's really sad. They're getting cashed out because there is the structure of the security was not such that they could get the shares of the acquirer, which they might want. So that's one of the things that I think we are really learning the mistakes of the past 6-7 years, in that if you don't think ahead about what your company's trajectory is going to be, you may end up not making your investors millionaires. And we do all want them to be millionaires if that's possible. But some of the other challenges that you and I talked about the other day, Andy, is you've really got to pay attention to things like eligibility. Make sure that the company is actually eligible to use Reg CF, because the rules are different for Reg CF than they are for Reg A. And we've seen some companies, especially in the real estate area, who can offer under Reg A, but can't offer under Reg CF. So real estate, always make sure that you are very clear about what the company's 40 Act status is before you decide to do a CF instead of an A. We've seen some ineligible companies in CF who are truly just investment companies, and there's no way around it. That's what they are. And one of the things I always say to clients in this area is step back. When you are pitching to your investor, what is it that they're investing in? What do they hope will succeed? And is it dependent on this company that is the issuer? Or is it dependent on some relationship with some other company? And in that case, is that other company actually the issuer here? Is that relationship an investment contract of some kind? In which case we've got investment company act problems, because investment companies can't use Reg CF or A. So you need, when you're planning, to really pay attention to the structure and always ask yourself the question, what is the investor investing in? Because you're going to end up with what we call co-issuer issues there. Other challenges is make sure that your financial statements are actually compliant. And if you are using an SPV, that means they have financial statements as well. And pay attention to the terms of the audit. If you get an audit or a review, make sure that the entirety of the offering, of the issuer offering, is actually being reviewed, because we've seen 1 or 2 circumstances in which the auditors have said, here's the consolidated financial statements. We have excluded this, overseas entity, it might be, and that's not part of the review or the audit. Your audit is non-compliant because you are not doing properly consolidated financial statements under GAAP. So there's a lot of little things to be looking at in all of these. I also think we need to make sure that disclosure is in fact complete and not misleading, and is consistent throughout. So if you're saying one thing in your financial statements, you need to say exactly the same thing in your the description of the company's financial condition. And the other thing I would flag is there are still some insane valuations out there, and I know the portals are not required to do the valuation. But at some point, FINRA is going to be saying, and has said, in fact, in actions it's brought in the past, is how on earth did you reach that? How did you reach that valuation? You've got revenues of 222,000. How are you worth $50 million pre-money? Magic, obviously, is the answer.
VC math.
Yes, but it's so much more inventive than VC math. It's wonderful, but do pay attention to those things, because that's going to come back and bite the industry. Other challenges is, as we have all talked about, the ongoing reporting. Once the company has done its offer, it does have ongoing reporting requirements. Reg A's got a kind of discipline built in, because you can't use Reg A unless you bring everything back up to date. Reg CAR, we see a very cynical approach to ongoing reporting, because a lot of companies are like, yeah, what are they going to do? They're not going to sue us. So they don't file their Form CAR on an annual basis. They don't post it on their website as they're supposed to. And what they do is, well, next time they want to use Reg CF, they just bring themselves up to date. If you are doing that, and that is a tremendously cynical thing to do, but if you're going to take that approach, when you bring yourself back up to date, file all the missing reports. And the portals should be making sure that all of the missing reports are filed, because otherwise the company is not compliant with Reg CF. One flag thing, the thing that I wanted to flag on the Reg A, I'm sure we've all seen the challenges in compliance for Reg A. Back in the summer, the SEC brought that group of 10, nice round number, 10 offerings, all with the same problem, which is the offering got qualified, and then post-qualification changes were made without complying with the SEC. Either the offerings didn't start within 48 hours as they have to. They changed the price by more than 20% by filing a supplement as opposed to a post-qualification amendment, or they failed to make their annual reporting, their annual, what we call the annual refresh post-qualification amendment. So my thinking, and nobody at the SEC will comment on this, obviously, is that was such a nice round number that there were probably several others being looked at the same time who may be still negotiating a settlement, because this was only a few months ago. And it was such a specific set of violations that I think there might be more little collections of enforcement to come. That's just my prediction. So when you're doing your Reg A, things to be watching out for that I really want to flag is, in order to keep a Reg A open for the full 3 years as you can, you really want to make sure that you are doing an annual update. And our friends at the SEC say, when you file your 1K, always take a look to see if the new filing that you've just made represents some kind of fundamental change to the offering that requires a post-qualification amendment as opposed to just filing it. Okay. So those are things people should be watching out for.
Yeah, so I think that the 10 enforcement actions that were filed against these Reg A Plus issuers, it was it was almost like they didn't really want to do it, but they had to, and every penalty was under 100 grand. You know, some couple I think were like around $10,000. But I think it's kind of a shot of across the bows, like, you know, hey guys, get your act together. And Reg CF, I mean, there hasn't been anything similar to that, at least that I've seen. But people do need to adhere to this. I think it goes back to working with an attorney that knows what they're doing. That's probably the first thing, but also working with a platform that they know what they're doing. So I'm going to jump over to Rebecca, because she was previously a partner at a very large law firm before she decided to roll the dice and launch her own company. And so from the deal maker perspective and from your personal experience, what have you seen regarding these issuers, and how are you guys managing that? Rebecca. Is Rebecca still there?
I lost my audio. Sorry, I think I'm back. Can you hear me?
Okay, yeah, I can hear you now.
Okay, sorry.
Did you hear my question?
No, can you repeat the question?
Yes, absolutely. So I was talking about everything that Sarah shared with us, and I was asking for your perspective, because you have a big law background. You were a partner at a very large law firm, very successful attorney, and you decided to give that all, you know, chuck that all away to become an entrepreneur. And so I wanted to hear about your point of view from what you're seeing, but also how your platform is managing this.
Yeah, thanks, Andrew. I think it's interesting. I was reflecting on some of the trends that you and Woody mentioned, because I think what we've heard a lot about this year is VC funding being down, right? So if you look at the quantum of VC funding happening, the stat you mentioned, it's back to kind of 2020 levels, which, if we all remember, was that year of COVID where the ecosystem of everything completely died. And so you've got a lot of folks in that funding sector that are really backing their top 2 companies and letting the other 8 companies die off. And, you know, I've spent my whole career helping founders. That's the law practice I built. That's the platform I built. So helping founders get funded is of core importance to me. And when a VC decides you're not in its top 2 portfolio and it's not going to fund you anymore, you're going to be one of the ones that dies off. That sucks for you as a founder. That sucks for America and America's GDP. But, you know, that's that industry's business model. So that is what it is. So I think if we look at the stats that Woody mentioned and how strong the industry is held up, I think it's been a real opportunity for us to show how this industry can help keep the American dream getting funded, keep folks doing well. And if I look at the top 5 customers of Dealmaker over the course of last year, those are actually companies that had raised from a community before. So a big portion of the communities doing fundraising this year are follow-on financings. So they're, interestingly, you've got communities saying, I like what these founders are doing, I'm going to continue to back them, and those companies continuing to do well.
Okay. So do you have any perspective as to how Dealmaker manages the industry challenges that are out there?
For sure.
Can you share that with us?
One thing we do, for example, is send out reminder notes to folks about their ongoing filings and disclosure, right? That's not something we're obligated to do. That's not something that falls with us, but I think it's good for an industry. You've got to remind folks when they raise money, okay, now you've got an obligation to spend it in accordance with how you disclose to investors, and you've got an obligation to keep your filings up to date. So I think we as an industry, you know, Sarah highlights things for us like ongoing disclosure, and then we as an industry look at how we can fix it. We also had 2 issuers go public this year on NASDAQ, which was exciting. So we've been thinking a lot about liquidity and the opportunities for investors. And, you know, the public markets have different challenges as a whole in the small cap space. But if that's going to be a natural path of exit for folks that are investing in community rounds, those challenges now become challenges of our space that we need to look at what happens on a fully retail backed offering that doesn't have institutional financing. How do those stocks behave in the public markets, and what can we do about it?
Okay. Eitan, would you like to share kind of your perspective of what you're seeing?
We're seeing a lot of growth in the industry as a whole, and within Dalmore. The last, we reported recently, as you know, the last 5 months, the average raise from our issuers has been over 50 million per month. October was over 70 million, and that's, I think, very significant in this time. I think it shows that there are retail investors out there that are participating in offerings. I think it's encouraging. As far as things that Dalmore does to kind of help keep issuers compliant, it's a never-ending process. It's a work in process. It starts with maintaining your own compliance culture within the broker dealer, and if you're a law firm, you have founders that are coming working to sign up for a capital raise. And many of them are doing this for the first time, and they don't have a lot of experience navigating this process. So it kind of falls on all of us to help navigate them right from the beginning, help remind them, because it's a good thing for all of us if issuers remain compliant, and for hopefully for investors as well. But it's again, we're at a time where regulations are changing, innovation and technology is at the forefront. So you're kind of like establishing best practices kind of on the fly, or Sarah Hanks is establishing best practices on the fly for the rest of the industry. But no, these are, like you said, this is a relatively young industry, and a lot of these questions come up, and things you would never think about, like non-compliance with certain components. Oh, okay. You see these trends happen. How do we do better to prevent this from happening going forward? Okay, let's implement that into our procedures, where there's these alerts that go out, or more clear up front about that. Again, not necessarily things that anyone has to do per se, but we kind of do at the same time, because it does affect all of us. So we're always looking to increase compliance from our issuers as best we can, and monitor trends. And these are the kind of things you don't want to have to learn from enforcement. One thing that I've noticed in the regulated capital raising industry is your thoughts, actions, and intentions better be pure, because they will be tested down the road, period. Whenever there's money involved and there's retail investors part of it, it might not be something that's an area of focus today, but it doesn't mean that 5 years from now, the deal that you did 5 years ago is not going to be front and center in your life. So you really need to be defensive when you're approaching capital raising, and super protective, which is why we preach all the time the importance of working with a very well-experienced firm that specializes in this, has gone through the process over and over again, understands the types of questions and concerns the SEC may have, FINRA may have, and other areas that you could get buttoned up, like with a lot of the work that Woody does on the blue sky side. These are all critical. And easy to overlook for if you sign up with a new platform that just came to it's in business for a year or two. It's not doing many deals. They may not have a compliance culture. They may not be tracking these types of things, but they are nonetheless very important.
Yeah, absolutely. And I think you made an excellent point there, because it's bad for everybody if people aren't dotting the I's and crossing the T's. And so I think it's encouraging when you hear that our platforms are working to channel people in the right way, and connect them with people who actually are experts in this industry, like Sarah. I think that benefits everybody. And the other point I'd like to make is that, and I said this earlier on, is that there has been very little fraud. I know there's occasional fraud, but there was a lot of people pounding the table before this industry started, saying it's going to be fraud gone wild, the sky's going to fall, and cats are going to sleep with dogs, and it never really happened. And so this kind of leads me into the next topic I'd like to discuss, is about the benefits. I know we hear the kind of the gloomy compliance stuff, which I love, but most normal people don't find very exciting. I think that there's just a lot of good that's happening within this industry. And as we mentioned before, there's more higher quality issuers that are participating in this. And Rebecca, you mentioned that you've had several issuers that are listing on NASDAQ. You had 2 issuers that somebody shared with me the other day that were listed as 2 of the most innovative companies in the United States or North America this past year. That to me is encouraging. Yes, this is long ball, but I think that we're seeing something that's really has potential for boosting prosperity and increasing jobs. So Rebecca, what's your spin on this?
Yeah, as I mentioned, we've actually got 3 now, a third one on Time's most innovative companies list, right? So you've got a higher quality of companies entering the space. We've got interest from larger companies as well, who are really seeing 54% more engagement from a community that becomes a shareholder in their business and can do good things for the business. My favorite example is Miso Robotics, a longtime community issuer who builds the robotics tools for fast food restaurants. They put out to their community for help in getting contracts. They get an introduction that leads to a pilot from White Castle. And then last weekend, you've got Saturday Night Live making jokes about the White Castle robotics arm. And that's really the time that we're living in 2023 in terms of innovative founders who very much understand the integration that exists today in terms of using digital social media platforms and how you can build a company and get that benefit from your community of followers and get to market faster and in a scrappier, more innovative way. So that's the kind of founders that we're seeing really entering the space, which is exciting and leads to greater opportunities.
Yeah, awesome. And that's what I'm seeing as well. And I know that Eitan, that's what you're seeing too. Woody, you distribute a data point about jobs created, and this is under Reg CF only. And if I'm a policymaker, if I'm a regulator, or I'm an elected official, this should compel me to help out. Can you share some of those data points that you shared with me the other day?
Yeah, so I mean, it was interesting because Reg CF was part of the Jobs Act, which was about creating jobs, and I didn't really put too much thought into how it was sort of couched in that area because I thought this was going to do more about taking money and democratizing it around the country and putting it in cities and states, which it has done through about 1,200 cities across the United States through Reg CF alone. But when you look at how these companies use the capital that they're raising, one of the things that they tend to do is hire people, rightfully so. I mean, you're scaling a business, you need people to help support that business. So they hire people. But these companies also come in with employees that are currently on their payroll. And we track, the number of employees that they have, the number of employees that are supporting the organization as well. And we estimate that there's about 440,000 jobs that have been both created and supported by companies that have raised capital through Reg CF. So when you're looking at what is a jobs engine, I think, crowdfunding can do that because, it's fulfilling that sort of prophecy that, this can be a jobs engine that helps support, people in local communities. These people have salaries and they can pay their mortgages and rent and put their kids through school. So it's really powerful in the sense that you're investing in businesses, not just for the business to grow and scale, but to help that business hire people that can help, provide more feedback and money into these local communities.
That's awesome. And Eitan, you and I were talking the other day, and you're in Israel right now. I've traveled there multiple times, and it's been known as the Innovation Nation. And what's that secret variable to develop something like that? And for me, online capital formation, securities crowdfunding, this is vital. And so I'm interested to hear your opinion about that, Eitan.
Yeah, thank you. Now, we have an affiliate to Dalmore Group, the broker dealer. It's called Dalmore Technology, which has been a big passion of mine over the last few years. Where we release capital raising technology tools, starting with a invest button that companies could put on their website to raise capital, all the way to customized white label apps so that they could have their own iPhone app to launch multiple offerings. So technology is definitely a big part of our focus and a big part of the industry. What's interesting, given the relatively small average investment amounts, that investors invest in these types of offerings, the CFs, the A's, and even in some cases the Reg D 506C, you're dealing with investments in the thousands, $1,000, $2,000, $3,000, much different than a 25 to 100,000 plus type investment. And investors are typically not speaking with someone before they make an investment. Unlike a Reg D with a much larger investment amount, they may have an investment advisor, they may be spending more time doing research and diligence and looking at comps. Because of the low investment amounts and the fact that you're able to market and promote these on platforms, the importance of having as little friction as possible, so that the transaction itself feels a bit more like an e-commerce like transaction than it does a traditional investment banking transaction, is really, really important and very easy to overlook. We've seen over 75% of investments occur on iPhones, in many cases with credit cards, which again, very, very unique to this industry. And something that is critical for founders to make sure that they have their technology up to par, in addition to a super strong operating business and a compelling investment opportunity that's articulated in a way that enough people will find that it resonates to them and take action on it. So the nature of how capital is raised online is I think very, very different than it is in the traditional way that we found in investment banking back in the days.
Yeah, absolutely. Rebecca, from your point of view, what are your thoughts on what Eitan just said?
Yeah, absolutely. I think one of the interesting stats in the benefits as well is on the minority founders. So not only are more investors getting access to a new class of alts that has great opportunity to rise, they don't have to just, put their money in crypto or NFTs. They can actually get access to legitimate private companies. But, some of the stats, if you look at Carta's numbers, there's actually been a decline in the number of female founding teams getting VC-backed funding for the first time in a long time. And you've got declines in some other categories as well. Meanwhile, if you look at Woody's stats on the crowdfunding industry, the sector has gone up in terms of the amount of minority founders getting funded. So previously, a couple of years ago, we were coming on these panels talking about 30% in crowdfunding versus 2% in VC funding. And now, Woody, you can speak to it better. I think we're up ginormously.
Yeah, if you look at November alone, it was 43.7% of all the offerings had at least one woman or minority founder. That's amazing. And the capital commitments, unfortunately, doesn't match the 43%, but it's moving up. And I think that's what we're trying to point out, which is, the women and minorities who have been shunned by, the markets itself and really venture capital, even though they put a lot of, mouth into saying that they want to focus on it. This, online finance allows people to be in control of their offering. And so they're in control of who they are, and they put these offerings out there and they're marketing to people that look like them. So the majority of the people, I think, that are investing in these deals are women and minorities too. And I think that's all part of the whole community aspect of it. They might not be able to write the big checks, but like to Eitan's point, the check sizes are not necessarily that big. They're moving up. I think in November it hit a high of $2,300 per check. But when you look at the median amounts, it's still about $1,000. A lot of people can deploy capital in that area. And I think it does benefit these women and minorities in a way that the other parts of the capital markets do not.
Sarah, do you want to chime in here? Because you see a lot of these issuers, because you are doing a lot of the Reg A's.
Yeah, well, Reg A's and Reg CFs, but yeah, it's absolutely true. One thing that I have noticed, and to go back to something you raised earlier, Andy, is over the period we have seen a real increase in the quality of the companies and the quality of the founders. One of the very early days, I'd get so excited when I saw that there was a female founder, only to find that her app was a way of reselling bridesmaids' dresses, and that was kind of disappointing. Now we are seeing more female scientists and the like, and that's tremendously exciting to see people with actual credentials. It's a good idea to resell bridesmaids' dresses, but somebody's already done that. That's not new. And so seeing founders who look like me or younger versions of me is really very exciting, and quality as well.
Yeah, and in the past, historically, you've had these little centers of venture capital activity, like Silicon Valley, Bay Area or New York City, and that still persists to a great degree. But you're seeing people scattered around the country that are participating in these offerings, are being entrepreneurs that are raising capital online that maybe they otherwise wouldn't be able to raise the money they need, because there's still a data point that people want to be close to the company they're investing in. But this kind of flips that upside down. And again, this takes time, but we've got two platforms here that are figuring this out and doing a great job with this. And Rebecca, maybe you can share kind of like, in looking back at 2023, what are some like high points beyond going public and beyond being recognized as the coolest product in the United States? Well, give me some like big moments for Dealmaker for the past 12 months.
Yeah, I mean, there's been a lot. One thing I'll say, which is anecdotal, is really it's been exciting to see, especially on the West Coast, there is an understanding of how these rounds can play a role in a financing strategy. That's a big opportunity. We saw the Substack raise this year, which was a big high-profile one. The Green Bay Packers continues to ignite a lot of excitement about what this space can do for folks. And so
that was you guys. That was you guys raised money for Green Bay Packers.
Right. And I think people, not everyone realized up until more recently that there's a reason that the Green Bay Packers is one of, if not the most valuable brand in the NFL, because of that 54% engagement from the fans, from their ownership structure. You look at the European soccer leagues. Okay, sorry, football, if there's anyone out there listening who's going to chew me on that. But, a lot of those teams being fan-owned, there's a reason that those leagues have been so successful today. And so seeing the adoption on the West Coast of some of the founders there who very much have institutional backing and say, alongside the strategy of Uber wanting to offer equity to the drivers to build that community and that engagement, there's a lot of founders who understand what they can do with this as a part of their financing strategy.
Hey, Tom, what about yourself? Give me some like high points in the past year.
So we surpassed 1,000 clients, which was pretty cool, and 1 million Reg A investments. And we surpassed 300 Reg A issuers that have been signed up with us, which was interesting. And most exciting to me was really some of the things we're doing on the technology side. The launch of our products, several of which are on our website. Most recently, Downmore Fraction, which is the white label app, Downmore Connect, which is our API, and soon Downmore Fund, which is for perpetual fund issuers. That's going to have fund administration built in as well. So that's really the direction we're going, in a modular way, building out relevant technology tied into our in-house transfer agent that allows for single sign-on and one-click checkout after someone has gone through the KYC process once. So these are the things it's really been a year focused on the rollout of different tech products. Fortunately, they've been going very well. We've been increasing clients that have been utilizing the different technology as well. But again, I would say we look at these exemptions maybe a little differently than many do. It's not necessarily crowdfunding per se, although they're typically used for crowdfunding because you could raise funds from the crowd and from anyone over 18. But really, they're tools that allow issuers to raise capital with whatever compliant share class structure and hopefully reasonable valuation from anyone over 18 pretty much in the world outside of certain problem countries. So there's a great need to educate some of the 30 million companies in the US who are not all even aware of this, because there was only like 1,500 Reg CS last year or something like that. shouldn't there be 1,500 a month or a week for 30 million companies? Do issue? My assumption is that many companies out there that may be watching this, they have a need for up to $5 million a year in equity or debt or preferred or common or safe or whatever that might be. They just don't fully understand what that means. What is CFDA? Do I need audits? I need lawyers. I need SEC. It's confusing. Do I list on a platform that's going to, market to all my customers and take them away? Yeah, they hear one thing or two things. But I think there's a great opportunity for broad education in the industry, so that more people are aware of the fact that for a reasonable and relatively small investment and relatively quick period of time, right? CF theoretically you could be up in 6 weeks or so if you move relatively fast. You could position yourself to raise up to $5 million at a structure that works for you. If you have an audience, amazing. But you don't necessarily need one because you are able to market and promote. And I think that we've gotten a lot smarter as far as observing what marketing and promotional strategies are working and which ones aren't. There's a lot of different techniques that you could utilize, provided that they're done in a compliant way, to market offerings, including webinars. There are compliant ways to even have influencers and celebrities on your team. There's obviously not compliant ways to have others promote your offering, which you have to stay away from.
Yeah, we found that out in crypto, didn't we?
But there are a lot of really interesting methods, techniques that issuers have been utilizing to position themselves to try to win before they start. And that could be done through testing the waters. It could be done through a lot of ways. But those are some of the highlights we're seeing this past year, and going forward, there's a lot to be said about where we see this industry going as well.
Let's talk about trends coming up in 2024, and we've already touched several of these. Rebecca, what do you see on down the road that is going to be a new kind of trend, or perhaps building on an existing one?
I think we'll see bigger offerings picking up probably in the latter half of the year. I think I align with what Woody said in terms of the markets coming back a little bit. I think we'll probably see continued attacks on the crypto sector. I don't think they're out of the woods yet. And I think, the Small Business Capital Formation Advisory Committee focusing back in on the accredited investor definition will be interesting. There's been talk there of increasing the financial thresholds. So, any changes they make to that definition are going to have broad scale impact on the sector and on crowdfunding as a result of it. So it'll be interesting to see what happens there.
Woody, what do you anticipate trends for 2024?
I'm seeing a lot of established post-revenue issuers come into the marketplace. When the industry launched, it was about 65% of the issuers were pre-revenue, less than 3 years old. Now 65% of the issuers have over $2 million of average revenues. They're over 3 years in age. So that, it's changing. And I think we're going to see larger issuers come in. This changed when the SEC went from 1 million to 5 million. So bigger companies clearly saw the opportunity and started coming in. And I think we're going to see more of those companies come in. But I think what I'm seeing when I look at the profile of the founders as well is I'm seeing more of the people that are leaving the Googles, that are leaving the Apples, that are leaving all of these companies saying, I want to build the next AI iteration that, Google doesn't want to focus on, but I think there's a market opportunity there. And we're seeing them, develop these companies and now come to Reg CF to raise capital from their peers in their community. And I think we're going to see more of that. One of the things that we launched in the last couple months was an industry report that digs deep into what's happening in a vertical within crowdfunding. And we did life sciences first. I mean, you'd be shocked to know that there's 300 offerings in the life science sector in crowdfunding. I mean, when you think about the capital that's needed and to know that 300 offerings have taken place in there, there's something to be uncovered in all that data. There's over 600 beverage issuers. Now, we've seen a lot of them from wineries and distilleries, but you have to dig down in the data to understand it. And the next issue that we're going to focus on is really this blockchain crypto world, because we think the opportunities in 2024 are going to be in that space. And I am a firm believer that, the next big companies to come out in the world that are going to be your next Facebooks and Googles and all that stuff are going to start their initial funding rounds through crowdfunding and through community finance.
Yeah, no, I mean, I've heard some chatter that more established companies are taking a more close look at this. And somebody asked a question about the number of issuers that are doing side-by-sides, CFD, and I don't know that number. I wish I did. But, that's an opportunity to roll in retail, but also do a very large funding round for a private firm. And I think that's very interesting. Sarah, what do you anticipate as a trend for 2024?
Yeah. Well, I'd certainly watch out for more acquisitions and exits and the complications caused by them, because this is just a continuing trend that we're seeing. One thing I would watch out for is something that Rebecca mentioned, that the changes, the SEC's changes to Regulation D have been at the top of their list of things we are working with for 2 years now, and they've been rumored to be imminent for 2 years. This is an election year. If it's going to happen, it's going to happen soon, or it's not going to happen at all. So I would watch out for those proposals to come out possibly, within the next couple of months, because that's, they've got to get them all the way through. And if that happens, then I think that the less availability of Reg D is going to be a more availability of Reg CF. Because where are the companies going to go? The other thing I wanted to mention is with respect to something Eitan mentioned, all of the alternatives and why do the companies not know? Every company that is talking to the SBA should be thinking about Reg CF for whatever it is that they, because you can do debt under Reg CF. And having recently worked with somebody who's gone through the SBA process, oh my goodness, the ridiculous questions they ask, the information they need. You think CF is difficult? SBA is much more difficult. So if you're talking to the SBA, talk to one of the platforms first before you make any commitments.
Here, I agree with that. Eitan, do you want to add anything?
No, I think Sarah did a lovely job. Not much more. I think that, again, like one thing I think for this coming year that I look forward to is the fact that the private markets dwarf the public markets. The problem is there's not a whole lot of order yet in the private markets. So how do you allocate to something without order, without liquidity, without market making, et cetera? It's more challenging. It's riskier, I think. That could change. It is changing, and it's a bit nuanced of how it's going to happen. You're not going to bring market making and liquidity to a one and done Reg CF offering anytime soon, in my opinion. Now, can you bring liquidity and market making to a private alt issuer who is utilizing these same exemptions but approaching it differently with a fund type compliant fund structure or a larger investment size, or a perpetual issuer or a REIT? That's more interesting, and that's something that is possible. And I think we're going to see music royalties, art, and real estate as the three industries that hopefully will merit a relationship with a market maker, which will then be a game changer, because then it becomes that much more compelling for RIAs to consider helping, allocating client funds or suggesting or adding these private alts to their platform, which they're really thirsty for, given the lack of interest in crypto related investments that they were interested previously. So there's a big appetite for private alt exposure, but it hasn't yet been presented in an organized, scalable enough way. And I think this is the year that we're going to see that bridge. And when that happens, it's not just going to be about a company having to get 1 million investors somehow. They're going to need to continue to do that too. But if you have distribution in place, it changes everything. It's not everyone's going to be able to participate in that. It's going to be a few to start, but I think this is the year that we're going to see those first few present themselves.
It's going to happen. You can see it like heading in that direction, and I absolutely agree with that. Yeah, so I mean, this is all really good stuff. I want to jump over to some of the questions because we're running out of time here very quickly. And back to the regulatory compliance stuff, I'd love to geek out with you guys on some of the stuff that they should be doing, they're not doing, but they're going to do that could harm the industry. So, but that's another time because I love all that stuff. Let's see. Let's look for questions. So somebody asked about the statistics of side-by-side for CF 506C. I don't know if Rebecca, if you have any perspective what's going through for your platform, or Eitan, either of you know how many issuers are doing that?
I don't have a number. We see folks do it though, for sure. It's one common structure.
Yeah, I don't have a number either, but it is common structure. We actually have a bundle for issuers who want to launch a Reg CF and a D. Because it's become a lot more common. Why launch in? Why prepare for the A right now when you haven't proven that you could raise a few $1 million from retail investors? So it's cheaper, it's quicker to get up and running. And if you're worried about capacity, then issuers could launch a parallel Regulation D offering, provided everything is compliant with all disclosures, and they can, so that their retail investors or the not yet accredited investors could participate through the Reg CF, and the accredited could participate through the Reg D. Once they see themselves raising adequate number of capital from non-accredited investors, they could then consider filing for a Reg A after that. So as a result of that, we're seeing a lot of issuers who are starting with the D and the CF.
Yeah. So I want to keep things moving because we have a bunch of questions here. How do we raise the limits? Okay, so that's a work in process. That takes time. That means call your congressperson, get more family offices and private wealth into this sector. And this is something that I think that should be encouraged, because I would like to see retail being side by side with larger money. And hopefully at the same deal terms. Woody, you're actually working on that a little bit, aren't you?
I mean, it's an evergreen thing. I mean, we believe that the cap should be moved from 5 million up to 20 million. I don't see much activity, and Sarah might be able to speak to this. I think there's more happening, but in the tier 1 space of Reg A. And I like to think that, Reg CF at the $20 million level could compete with what's happening at the tier 1 level. Because I think it solves for a lot of problems. One, it brings transparency to what's happening in the private capital markets, which doesn't exist. Two, it allows more capital to get to these companies that want to raise more than $5 million and hence might not use Reg CF as a mechanism to do it. But it provides this pathway, this blueprint to follow, which doesn't exist before. And I really like that about the structure that's in place, because we've got disclosures that are in there for investors to benefit from. And when you look at these offering documents, it can be quite detailed as to what they're providing. So, I know that, there's questions about fraud in the marketplace, but because there's been so few enforcement actions, I believe there's an argument to increase that cap from 5 million up to 20 million, so that we can have more opportunity in the marketplace for larger issuers that are more established to come in and raise capital. Okay,
I agree with you. I'm not going to argue with that. Eitan, what about your thoughts about getting more professional money side by side with retail investors? You've already kind of touched on this a little bit.
I'm all for it, 100%. It does have its challenges. I think the nature of new issuers being able to come to market on their own terms and go out to their own community oftentimes produces or encourages in some way structures that are more favorable for founders than they may be able to get from VCs or private equity firms. And so as a result, those terms might not be appealing to VCs or private equity firms, like non-voting, et cetera, or valuation process techniques, et cetera, or the lack of certain covenants. So I think it's going to be a challenge, although that would be incredible if, and I think, there are platforms, I think like WeFunder, that have done community rounds. I'm all for, the little guy being able to invest along the VC that's done serious homework and diligence. I mean, as a BD, that sounds lovely. And I think that sounds like a really sustainable thing. I just see it also comes with certain challenges as well.
Rebecca, do you have any thoughts on that?
I think Eitan said it. I think we'd love to see it. I think we do see it more anecdotally, and Different issuer driven is where we see it, where they kind of put it together themselves. So they are mindful of those challenges of differentiation in the valuations and things like that. You've got some folks out there putting together more retail led funds, which then allow for retail to invest alongside the VC. So you know, you've got a sector that there are various approaches being tried, and to the extent that one becomes the pathway forward, that'll be really exciting.
Yeah, Rebecca, very quickly, another question, because you are based in Toronto. Can you share about how you can do like a cross-border US Canada offering? Because I know it's happened, and also EU. I know you guys have ambitions to set up shop in Europe, but do you have any? Can you share how that works?
Yeah, so you need to be mindful when you're selling securities in a jurisdiction of the securities law in that jurisdiction. And so because our technology has the Canadian exemptions coded in, it allows an issuer to safely bring on board Canadians pursuant to the Canadian securities law exemptions. And so when you're going abroad into other international jurisdictions, there's different ways that you can be compliant in some of those jurisdictions, some of which are easier than others. And so depending on how you want to structure your offering and how much you're going to sell and how actively you're going to sell in a specific region, you just need to focus on understanding the laws of that jurisdiction and complying.
Yeah, and just to add to that, European Union not too long ago approved regulations to allow cross-border crowdfunding before it was by each specific EU country. UK is different, but that's just like starting to gain some traction now. But it could be, it's 5 million euros is the amount of issuers can raise. I think we've answered some of these. There's a lot of questions here. I'm gonna have to look at these later, but I'm gonna go, because we're running out of time. I'm gonna go around the room with final words, and I'm gonna start with you, Woody. What's gonna be big news for 2024?
I think it's just going to be a rebound. I think there's an investor confidence in the marketplace, and I think that's going to lead to more capital. I think we're going to see more issuers come in. I think the story is going to be, women, minorities are biggest beneficiaries, or some of the biggest in the marketplace. And I think it's going to drive more action in the market. So those are some of the key headlines for me.
Rebecca.
More innovation, more exits, and bigger brands.
Awesome. Sarah.
Yeah, I would agree with the more innovations. I mean, there are so many things that we didn't anticipate Reg A would be used for, like the securitization of sneakers and racehorses and diamonds and all of those things. So there'll be more of that. And I think the private markets will follow the IPO markets. Assuming the IPO markets recover, I think we'll see a building year.
Yes. Eitan.
I think the incorporation of AI into capital raising and how analytics are tracked and decisions are made and automation is done relative to raising capital is going to continue to evolve, hopefully producing more and more predictable processes for issuers who are considering a capital raise. Marketing and promotion is critical for the success of an offering, and oftentimes not as predictable across different issuers and different industries. I think we're gonna see more predictability. There's better technology. There's more evolved marketing strategies that we've seen. I think that's going to be helpful to issuers as well. And again, really, it's going to be a year where there's a breakthrough. There's going to be market making for private securities for some. That's my prediction. And we look forward. We already have a few issuers who are working towards that path with us, putting these things together in the back end through APIs. And so I see next year the year where account holders at banks, credit unions, and at RIAs will be able to allocate to private alternative investments on their own technology through an API to firms like Dalmore, Dealmaker, et cetera. that are involved in the primary issuance and secondary market trading of these securities. And I think that's going to be profound because of the potential market size is so much bigger than the public markets.
Great. That's awesome. Yeah. So I think innovation and entrepreneurship will charge forward, improving things and making things better for everybody, as long as the policymakers are not obstacles and they look at themselves as partners in facilitating this marketplace, which they should. So this is all very great. I want to thank everybody who attended today. Thank our panelists. You guys are awesome. It's great to see everybody. And I hope everybody has a great holiday season. I'm looking forward to 2024, where I anticipate great things. So take care, everybody. Thanks for joining us, and we will be back in 2024. All the best.